The Empire State Manufacturing Index came out. It was a negative 9.1 year over year over the previous year. That's down from a negative 1.5 print, which means manufacturing is absolutely cratering here in the United States, especially that manufacturing as measured by the Empire State Manufacturing Index. It's a lot worse, almost twice as worse as what the experts had expected for the month. Hey everyone, this is Rob Kientz from goldsilverpros.com. I'm recording this on October 21st, 2022, and you guys will see it Sunday night as the market opens. I'm back with a weekly market wrap-up where I look at the biggest economic events during the week. We take a look at the gold and silver markets, and we give you a little bit of preview of what we expect to see over the week ahead. We'll go ahead and just dive right into the economic calendar, as we always do, to start off these market wrap-ups. So as I mentioned last week, the biggest thing that I was looking at this week was going to be boots on the ground sort of intelligence and data points around manufacturing, around housing. And true to form, on Monday, the Empire State Manufacturing Index came out. It was a negative 9.1 year over year over the previous year. That's down from a negative 1.5 print, which means manufacturing is absolutely cratering here in the United States, especially that manufacturing as measured by the Empire State Manufacturing Index. It's a lot worse, almost twice as worse as what the experts had expected for the month. It just means that manufacturing is falling a little bit faster than what the market had expected. It is definitely not in a positive place for the United States right now. The industrial production index, however, was up slightly at 0.4%. And I'm going to read to you the headlines there. It rose 0.4% in September, the Federal Reserve reported Tuesday. The gain was above economists' expectations of a 0.1% gain, according to a survey by the Wall Street Journal. Output in August was revised to a slight decline in 0.1% from the initial estimate. Capacity utilization rose 80.3%. So essentially, we are using some of our capacity, and there has been higher capacity utilization rates, but it's not on existing production. It's on previous production, and it's an inventory ramp, which I've been talking about. We've had a boomerang in the markets from when we restarted due to the COVID pandemics. We've now created too much stuff. People can't absorb that because of declining purchasing power, and therefore it's increasing the overall amount of inventory we have as measured by capacity utilization rate, not necessarily being reflected in current production and current sales. Also turning to home data, the NAGB Home Builders Index was down to a 38. Last month it was a 46, and experts expected a 44, although it has fallen more than to be expected. Building permits held steady at 1.56. Although housing starts are down at 1.44 million, last month they were 1.57 million. So both building permits and housing starts are down from last month, although building permits came in slightly higher than expectations of economists, while the housing starts came in lower. And I'm going to read to you why that is the case straight from the press releases. Here we go. Construction on new U.S. homes fell seasonably adjusted 8.1% in September to 1.44 million, the Commerce Department said Wednesday. The drop in construction on home reverses a sharp increase in August when housing starts rose 13.7%. Economists polled by the Wall Street Journal expected housing starts to fall to 1.47. On a year-on-year basis, housing starts are down 7.7% in September, which means dating back to last September, they're down 7.7%. Building permits for new homes rose 1.4% to 1.56 million. Economists had expected them to be 1.4 million. The big picture is the housing market is weakening rapidly, exacerbated by affordability concerns. Analysts are hoping that mortgage applications continue to applications continue to fall. Last week, and mortgage rates continued to climb. Starts on new holes for houses fell 4.7% in September, while apartments fell 13.1%. So apparently what is happening is exactly what I said on the show last night. If you watched our Gold Silver Pros premiere last night, the name of that was Current Real Estate Collapse Predicting a Nasty U.S. Recession. We were talking about data from Case-Shiller and from the National Association of Realtors showing that the housing market is in a bit of a free fall. However, the markets today are doing quite well. At the time I'm reading this, at noon 15 on the 21st, the Dow Jones is up 1.73% at 30,859. The S&P 500 is up 1.51% to 3720.40. NASDAQ is up 1.28% to 10,751, and the Russell 2000 small cap is up 1.62% to 1732 on expectations that the Fed may have just said that they've been too aggressive on rate hikes and may slow those rate hikes down. Why would they do that? You ought to know it could be the aforementioned real estate market, which is tanking, which is coming after the sell-off in the stock market and the rising interest rates on the bonds. So the entire market is now coming under pressure. The Fed has realized that, and they may start to slow down, although I don't think that they're going to stop their quantitative tightening program. Time of this report, gold is trading at $1651.92. It's up $25.06 or 1.54% so far on the day. We'll see where it closes on Friday. Silver is up $19.16. That's up 56 cents or up 2.97%. We're going to do a share screen and show you what's actually going on in the gold and silver markets, where the spot price is actually determined. We're here on the CME Group's website, where we're looking at volume and open interest for the gold market. As you can see, there was about an even amount of gold interest in the marketplace for the dominant December contract. At close, we had 363,302 contracts of 100-ounce gold trading, settling at, we'll get into settlement in a moment. We had 1609 exchange for physical, which is exchanging a contract on the COMEX for a contract on the London market, either to take advantage of differences in price or to take physical delivery of the metal. As we move over to settlements, we can see that yesterday we had on the December contract 164,354 contracts close at an average price of $1636.80, which was up $2.60. Going back to the previous day, Wednesday's day's trading, there was 179,910 contracts closed, having gold down $21.60 at an average of $1634.20. Moving over to silver, also reporting off the CME Group website, which runs those markets, a little bit slightly higher than average elevated volume in silver. Looking at the data for the December contract, as I've highlighted here, 110,644 contracts closed. And we see that 325 went to exchange for physical, meaning they were moved over to the London market from here. Looking at the settlement data yesterday, we had 58,505 contracts closed on the December contract at an average price of $18.68, causing silver to rise 33 cents. If we look back on Wednesday's data, different situation, but the same direction as gold, 36,787 silver contracts closing, down 24 cents average to a price of $18.35. That explains the movement in gold and silver. Now, as to why those price effects took place, we go to the Commitment of Traders report from CFTC.gov as of October 11, 2022. It is backward looking over the data that actually created the prices on this market. That's why we look at the data and we look at the positioning by the big players in the market, and those are broken down to us by the CFTC as producer merchants. Those are actually producing the metal, the miners, or the merchants that are using it. You have a lot of short contracts there because they're covering downward price potential for silver, especially the producers, and that's typically the case. We have the swap dealers, also known as the bullion banks. It's the four big bullion banks in the market that we talk about all the time. They are net long silver, and they've been net long silver for the last couple of months. And net, they dropped slightly more short contracts than longs, but they're still at about the same position they were a week before. It's clear that the swap dealers, or the sharps as I call them, or the smart money, is expecting silver price to rise over the medium term. That's why they position themselves that way. The managed money made a big change. They dropped 4,300 long contracts and added 1,130 short contracts to silver, thereby almost moving to a net even position, as you can see here, 33,493 long to 33,378 short. They're relatively neutral positioned, and so they're not sure where the silver price is going to go. The other reportables, which are the wealthy individuals and family offices, dropped 3,798 short contracts and added 405 long for a net change of 4,100 to the long side. Clearly, the smart money and family offices on the market are expecting silver to rise. That's our expectation as well, on lack of physical availability, which we'll get to here in a moment. Looking at gold positioning on the COMEX exchange as reported by the CFTC. You can see here this table that we're looking at. Not a whole lot changed from what we saw before. Of course, there's more shorts in gold from the producer merchants protecting their downside price risk. They added 2,980 short contracts and subtracted 536 longs for a net move of 3,480 contracts of 120 ounces of gold to the short side. Obviously, the producers are expecting more downward pressure on the price of gold, and that's why the price of gold fell last week, was because they added more short contracts. which led us to a lower gold price, as you can see here in the data, making those connections for you so you understand how the market works. Looking at the sharps or the smart money, the swap dealers, they dropped 3,300 longs in gold and added 357 shorts. They also expect gold price to see some weakness in the future. That's why the price moved down. Managed money dropped both long and shorts, but went slightly more long by dropping less long. So their net exposed a little bit more long side. Still net short though, about 5,000 contracts. The smart individual money, the other reportables and the family offices are still net long on gold, expecting gold to go long in the future. They dropped 3,700 short contracts and added 1,000 longs to go net long about 4,800 more contracts. So clearly the big smart money is expecting gold to go up, whereas the swap dealers are expecting it to go down. Interesting developments in that market. Looking at the ETF side for silver, note that most of the silver for ETFs is stored in London, some of it in the US and other places. But by and large, this is a good read on how the London market is doing in terms of their silver stored. And we can see net over the last 4 weeks, down 21 million ounces of silver between the American and the London market. London overall has seen a net decline as well, although the SLV for the last 4 months is running positive. They're starting to see more silver come in. You can see that on the SLV chart right here. There's a little bit of an uptick in the amount of silver held in London for SLV, although overall for the ETFs in London, it has come down, and you can see the one big loss was out of ETF securities, PHAG, SAVRP, MAG, losing a lot of silver. Net overall silver coming down, and we'll see that on the London chart here in a moment. In fact, let's take a look at it. Here's the chart as of the lbma.org.uk. And you can see that gold is slightly down, but silver is trending down very sharply in terms of ounces held in London. And that is because of these ETF numbers and the amount you see coming off there and this overall number here. That's how you tie those numbers together. Looking at gold, we've had a net 4-week move down 3.7 million ounces. We see the COMEX net is down, although there was some positive movement of 65,000 ounces into eligible. There was a decrease of 1,100,000. 43.795 ounces out of registered in COMEX, and that is the liquid tradable gold, which means gold is coming out of the COMEX in terms of what can be delivered on contracts. And total a net decrease of just over 1 million ounces on COMEX the last month. And you can see the ETFs are bleeding out of London a lot of gold as well. And you can say that in the chart, this is where that gold's coming off very slowly. A lot more gold held in London than silver, respective to what's being taken off of the exchange. So again, expect to see a shortage in silver around the world much faster than we see a shortage of gold. And so I think that's going to change the narrative to where we see silver spike before we see gold spike this time. That will be a change from the past, and it's due to industrial and retail demand in the physical. It's not manifesting yet in prices right now because the derivative markets aren't aware of it. When that news hits the derivative traders, they will flip long in silver, and that will cause a nice pop. And I think that will cause people to start paying attention to gold, platinum, and palladium at that time as well. And we'll see what happens to those markets. Looking here at gold price in Chinese renminbi, I wanted to point out, if you go back and look to a gold and silver chart, gold for the last 30 days, if you count its high during the month, is down 4%. Silver is down 6%. In the American market, if we look at gold in the Shanghai, it's only down 2% from its high on October 3rd. Note that gold peaked on October 3rd in both the Western and the Chinese markets, but that China fell less because it's a more robust positive market for gold price. And that's why gold in China is priced higher when you do the conversion to US dollars than it is in the Western markets. Those Chinese markets are more delivery, as we're going to show you by the data. We simply go to the Shanghai Gold Exchange and pull their monthly report, and you can see how much the trade is in terms of a percentage of the overall. So if you look at gold, look at the delivery volume of contracts, 721,876, trading volume of 931. So about 77% of the gold contracts in the Shanghai market are delivered in physical, 77.52%. It gets nowhere near that in the deliveries on this market. If we look at the deliveries for any given day on the market on the gold chart here for the US, you see 175 deliveries out of 363,000 contracts. That's not even a percent. It's not even a half of a percent. And then we change the days, go to Thursday. You look at delivery 16 off of trade of 365,000. If you go to deliveries for Tuesday, you see deliveries of 54 divided by 46,335 contracts. That is a minuscule amount when compared with delivery in the Shanghai. The Shanghai is considered much more of a delivery market. much closer to the actual physical gold price, and that's why gold prices are higher on the Shanghai. If you look at silver, 18.79% deliveries, that's still much higher than it is on the COMEX. If we look at the COMEX, for example, we're looking at Thursday's data, 3 deliveries out of 110,000 contracts, not even maybe a tenth of a percent. On Wednesday, 0 deliveries, 110,000 contracts. You can see the data there. Tuesday, 2 deliveries on 109,000 contracts. Different situation in the Shanghai, much higher deliveries. Therefore, I think is a much better price market in terms of physical, as delivery ratio is much higher. Now, how did the Shanghai do in terms of actual gold? It's actually down slightly. Here are the different batch of products that they sell. I won't get into that. This is in kilograms and this is in renminbi, but I wanted to show you the change from previous month. So down the previous month, 19.03%. If you look at the bottom of this table, this column, month to month, the gold deliveries are down 19% on the Shanghai, which just means that there are less contracts 19% in September than they were in the previous month in August. Not a big deal there in terms of the overall amount. In terms of renminbi dollar amount, it's only 12.63% down. Why? Because the renminbi has strengthened relative to the gold price. So even though the actual physical is down 19%, the in renminbi, it's only down 12.63. That is going to be your market report for today. I'm going to give a real quick preview over the economic data points that we're going to be looking at next week. Next week, we're going to look at the Chicago Fed National Activity Index, the U.S. manufacturing PMI put out by the S&P, the services PMI put out by the S&P. That will tell us how much we're growing or not growing leading into the next GDP print. We're going to look back at Case-Shiller Home Price Index, which we spent a lot of time looking at yesterday, Consumer Confidence Index, real gross domestic products, initial and continuing jobless claims, durable goods orders, and the core price indexes, which will be out next month. We think those are going to be very important data points for you to follow. This is going to do it for our weekly market wrap up. If you're on the Gold Silver channel, Gold Silver Pros channel, stay tuned for Ian giving us his metal market update. If you're on JM Bullion, that'll wrap it up for this week. Stay tuned for more content on that channel as we go forward. This has been Rob Kientz delivering your weekly market wrap up for the week of October 21st, 2022.